Welcome to the Oil Minute, creating unlimited value in the oil patch. I'm Zachary Rogers. Happy Valentine's Day to all those who celebrate. This is episode 17. We're going to talk about the politics of refining in terms of whether or not they're national security assets, energy dominance externalities, kind of an analysis on the Trump administration's energy policy, and is Brent overpriced? So, first story. So, a few days ago, John Kemp at Reuters posted an article about our refiners and refining assets, our refineries' national security assets. And the article, to kind of summarize his point, is that he took the thesis that they weren't national security assets. I disagree with that, but I'm going to try to summarize his point as best as possible so that I could try to criticize it based off of some, actual logical basis. So to summarize his points, so basically, are they national security assets? So you would have to basically envision a scenario where you have fuel shortages if you're a nation that doesn't have refineries. And the reason that this is coming up is because Australia is shutting down refineries and they're an island nation, and of course they'll be dependent on imports. So he went into some context about World War II and how, back then it took a long time to respond to some of these threats. Of course, today with advanced air power and fighter jets, the rate of responding to a threat is much faster. So the risk that you're going to deplete your national petroleum stockpiles is lower. That makes a lot of sense. Also, he talked about a soft, mutually assured destruction scenario occurring. So if a nation actually blockaded you away from fuel, that would basically prompt a war. So in order for nations to avoid war, they avoid that scenario, which is called mutually assured destruction. It's kind of the thesis around game theory around why so many enemy countries have nukes, but they never use it. It's because if they do, the world's basically over. So if you create a mutually assured destruction, that reduces the incentive to get to a place where you don't have fuel. That makes sense. And even if a country has large refining capacity, this is his point, it doesn't guarantee that it doesn't need to import crude. Again, so a refinery takes in crude, converts it to products. So this was a dilemma for the United States for most of the past 40, 50 years, was that we had a ton of refining capacity, but we needed to import crude from sometimes hostile regions, which we argued was a national security threat. And ever since shale came along and basically we became the largest producer, well, the U.S. doesn't really have to worry about that anymore. So, kind of Kemp's thesis is you'd have to approach a relatively implausible scenario to reach the level where security of the nation's fuel supplies is impacted, where a country actually is blockading, and they can do that with getting away with it without military response. So it's not a weak argument, but the reason that I disagree with it is because it seems to exclude the concept of leverage. So let's disregard the scenario where somebody blocks your fuel supplies. On a high level, if you have a hostile nation that supplies you fuel, then you don't have leverage against that nation. So in terms of economic deals, trade deals, military, economic affairs, you're not going to push the nation that actually supplies you fuel or crude actually just fuel. You're not going to push that nation very hard. So they will have immense leverage over your nation in terms of policy, in terms of kind of where the future goes for you as well as that nation. So I agree with Kemp's argument about the MAD, the mutually assured destruction, and a blockade seems relatively impossible. But I don't think it's desirable for a nation to be supplying their fuel from a nation that can be hostile. So this is very important for nations that don't have refineries to secure imports from nations that are friendly to them. Otherwise, I do believe it's a national security issue. So that's kind of the reason I disagree with that. So moving on to Trump's energy policy. Okay, so there's a little known externality, I believe, around Trump's energy policy and how it basically benefited China immensely. Probably not intentionally, of course, but I do think that this occurred. So it comes down to two factors. So energy prices and sanctions. So on the energy pricing front, so of course, Trump administration, as well as Obama actually, by lifting the crude oil export ban, they allowed U.S. oil to flow to the globe and they encourage production. So the more supply of oil you have, of course, the price goes down, all else equal. And under the Trump administration, we saw immense growth of crude oil production to the highest in the world. Partially, it's a function of the type curves of the Permian. So the Permian generally has wells and formations that produce very quickly high initial production rates, but they have steep decline curves. So you produce a lot, and then it declines very fast. So that actually kind of feeds into much of the criticism of shale as an investment, depending on the timing of the production cycle, but we won't go into that. But in any case, so natural gas and oil production steadily increased under Trump. So that overwhelmed the global balance. So the energy benchmarks across the world, even with relatively, strong demand across the globe until COVID, energy prices were very low, which was obviously good for the consumers across the world. But it creates a situation that China can exploit. You mix that in with the sanctions, and this is kind of where it turns to China. So the U.S. had sanctioned, up until Biden got elected and now he's in office, we've been heavily sanctioning Iran and Venezuela. They're two major crude producers in the world, and very, very important is that they produce heavy crude. Heavy crude is sought after by very complex refineries that can turn the sort of discounted crude, which is bad quality, they can upgrade that through their cokers and hydrocrackers into high valuable products. So they make a lot of margin if they can source heavy crude. So the U.S. sanctioned Iran and Venezuela and basically told all of its allies that they couldn't produce or they couldn't source Venezuela or Iran crude. So when a crude is sanctioned, it doesn't mean that that crude just disappears. A portion of it, and it's arguable actually how much, will shift to just the black market. So it'll just shift to this sort of unknown, kind of off the books transactions where it's blended or marketed as an alternate crude, such as Malaysia crude. That's what's happening with Venezuela. But the important thing is that if you are Iran or Venezuela, you don't have many buyers because the U.S. is sanctioning the entire world, basically. So if somebody shows up to buy your crude, you basically have to discount that price. So Trump, through his policies, pushed down oil prices, but then also with the sanctions, he sanctioned these two heavy crude producers, Iran and Venezuela. So you have low oil prices, low benchmark prices, and then you have sanctioned heavy crude of Iran and Venezuela, and they have to discount even farther because they're sanctioned. So you can see that this price that's actually being paid to these nations on the black market, again, this can't be verified based off information I have or anything, but it's just pretty well known. It's very discounted crude. So if you have a buyer willing to take that risk, and it's pretty clear that China was doing that and is doing that, they can rapidly stockpile heavy crude, which creates an extreme strategic advantage on the crude cost side of your refining economics. So you mix that in with what happened with COVID, and oil prices were depressed for a long time. So they were basically able to have a fire sale of just amazingly discounted crude that went into their national stockpiles. And again, it's almost impossible to really verify the quantity because China's government doesn't really post these things publicly. It's considered national security information. So, that being said, how that benefits China is, of course, they can source very, very cheap crude, and nobody's really doing anything about it. Especially now with Biden in office, I don't really think he's going to stand up to China as much as Trump did, but that's just my only sort of political comment for the day. But with the crude sourcing advantage, and China's been increasing its refining capacity and complexity, which means that they can convert this very complex crude, or heavy crude. This basically causes them to be the main player of the Asian refining market, in the sense that they are backed by their own central government. They have sourced discounted, illegally purchased crude at a very, very cheap rate. And now with them increasing capacity, they can basically flood the Asian basin with product. So if you have a virtually costless source of crude relatively, and you are backed by your central government, and you can flood the market with product, other refineries in the region that might be operating off of a market-based system and not as much centralization, it's going to be really hard for them to compete with that. So this kind of feeds into our first story about how Australia is shutting down its refineries, and other nations in Asia are going to feel the pressure too, because again, they can't compete with these economics of heavily discounted crude and flooding the market with product, and basically backed by the state. That's a pretty good economics in terms of trying to beat your competitors. So to kind of recap, Trump's energy policies pushed down oil prices, and the sanctions on Iran and Venezuela allowed for China to source heavy crude at an extremely attractive price, discounted price. Then they increased their refining capacity and complexity, so now they basically have an enormous advantage in the Asian basin market of refining, which is going to put a lot of pressure onto their nation's refineries, which, again, to my first point, might be a national security issue for the future of those nations. So that's kind of something to watch over the next few years. Okay, so back to today's market. Is Brent overpriced? So I think Brent's pricing at around 60 at the moment, something like that, because everybody on Twitter is talking about it. I'm really skeptical on the price of Brent. Again, the price of Brent is almost impossible to forecast. Anybody who says they can, it's just not accurate, especially in the long term. So I realize that the crude supply side is in cut mode with OPEC plus cuts. Biden's policies are going to be very friendly to U.S. producers, so that might kind of put a weight on U.S. supply, which makes sense. But on the crude demand side, it's just I don't see anything supporting a 60 level of Brent. I mean, unless we believe the numbers out of China and they're just setting records for demand, which is difficult. India is positive, but if we discount India's positive numbers, the Atlantic Basin just seems to be unhealthy on the demand all across the barrel. Virtually all clean products in the U.S. are balanced in terms of their stocks. Gasoline's, I think, is under year on year. Jet is definitely under, or lower year on year. Diesel's overbuilt a little bit, but that's come down recently, so the stock levels look okay. And of course, diesel demand's actually been pretty healthy, but that's because everybody's at home and they're basically, using Amazon diesel trucks to get all their products nowadays. So I think gasoline could see upside because vaccine could come out, but jet fuel returning to pre-pandemic levels is just virtually impossible to imagine this year. You might have some leisure travel return, other nations open up, but a full-scale carte blanche international opening of borders the way it was about a year ago just seems impossible to really happen this year. So that keeps about 5 to 10% of the barrel uneconomic. And it's a middle distillate, it's an upper middle distillate, so it's going to pressure diesel. So if diesel economics are really, really good and gasoline economics recover, if refineries increase runs, that's great, but then they have this jet problem where 5 to 10% of their barrel is going to be uneconomic. They're going to blend it down into diesel or something, and that's going to weigh on diesel. So that's going to cap a lot of the middle distillate performance this year. So all that being said, I don't think runs are going to surge in the Atlantic Basin. The U.S., of course, they might go up, but that is going to be heavily tied into the export picture. So LATAM, Mexico, Europe utilization is low, and if those refineries can't, crank back their runs, then the U.S. can fill in those exports. But again, I mean, that's just going to be a supply push at this point. There's really no demand strength in the Atlantic Basin to soak additional barrels into those markets. So even though the supply side seems a little bullish at this point, I just don't think the demand side is supporting it. But again, forecasting Brent is impossible. But I just say that the price risk is to the downside. That's all I had for today. I'm Zachary Rogers. This has been the Oil Minute.